Hello, and thank you for joining us here at PhillipCapital Market Watch. I'm Natalie, Research Analyst with Phillip Securities Research, covering the REITs and property sector. Today, I'll be talking about the 2020 outlook for S-REITs, as well as give an update about our respective subsector preferences. With interest rates expected to remain low, we expect S-REITs acquisition momentum to continue. The market saw 3 Fed rate cuts in 2019, totaling 75 basis points, bringing the Fed rate to 1.75%. The 3-month SOR also fell 41 basis points from 2% at the start of 2019 to 1.6% at the end of 2019. The lower interest rate environment was conducive for S-REITs as the lower cost of borrowing made levered acquisitions more accretive. Demand for yield instrument also pushed REITs valuation up, making equity issuance less dilutive. S-REITs raised a record $9.5 billion from Singapore equity markets in 2019, double the amount raised in 2018. Including funds raised from debt markets, S-REITs raised $20 billion, which was primarily used to fund acquisitions. Singapore remains an attractive market for REIT listings. Elite Commercial REIT debuted on the Singapore Exchange on the 6th of February, with several REIT IPOs already lined up. With new asset classes such as the Hampshire US REIT grocery and self-storage portfolio and SPH's portfolio of student accommodation assets coming to market, Singapore will only grow in prominence as a vibrant REIT market, leading to a virtuous cycle of more REIT listings. 3 mergers in 2019, and the merger and acquisition theme is still going strong. Be it through mergers or sizable portfolio acquisitions, the desire to scale up, fortify their portfolios, and increase competitiveness remains a key goal of REIT managers. Of the 3 mergers we've seen in 2019, 2 of them would create a diversified REIT, expanding the REIT's investable universe. The proposed merger between CapitaLand Commercial Trust and CapitaLand Mall Trust, which was announced in January 2020, will also widen their investable mandate, creating a diversified REIT. Our preferred subsectors are the commercial and industrial subsector. The office rental index showed signs of moderating after 11 consecutive quarters of growth. However, given the 3-year office cycle, positive rental reversions are still expected given that passing rents are still below market rents. Supply hitting the market is moderate at 2.5% of the current office stock. Industrial rents and occupancy held steady throughout 2019 despite the cloudy US-China trade outlook. Within the industrial sector, the high-tech, high-spec subsector and the business parks remain more sought-after asset classes. Of the 4.4% of supply coming onto the market in FY20, 70% of the supply will be coming from the light industrial segments and will put pressure on the rents and occupancy. However, 50% of the light industrial supply are built to suit assets which are already pre-committed. We see opportunities within this sector. Active portfolio management has Ascendas REIT and Maple Tree Industrial REIT embarking on asset redevelopment and repositioning to convert some of their light industrial assets into higher yielding high-tech, high-spec assets, reducing the competition among the light industrial class and future-proofing their portfolios. We are cautious about the retail sector despite the tepid supply coming onto the market, as the weak retail outlook categorized by the negative growth in RSI throughout 2019 leave much to be desired. Nonetheless, retail REITs under our coverage, Fraser Centrepoint Trust and CapitaLand Mall Trust, outperformed the market with their portfolio occupancies in the high 90s and achieving positive rental reversions. We downgrade our view on the hospitality sector to neutral in light of the novel coronavirus epidemic. While the sector is experiencing favorable supply conditions, the weaker tourism sentiment and ban on Chinese tourists will impact Singapore's tourism significantly, given that China is the largest contributor of international tourists, accounting for 24% of arrivals in 2019. That's all for PhillipCapital's Market Watch. Tell us what you think in the comments below. Remember to like and follow us on social media and subscribe to us on YouTube. Thanks for joining us and see you soon.